All right, so you want to be a smarter investor, right? I mean, who doesn't? Well, today we're going way back to the basics, back to the OG of value investing.
Yeah, we're cracking open Benjamin Graham's The Intelligent Investor, and not just the original text.
We've got Jason Zweig's commentary, too. That helps a lot.
It does, definitely. It kind of bridges that gap, between Graham's wisdom, which is timeless, and today's crazy market.
I mean, think about it. It's like we've got this direct line to one of the greatest investing minds ever
We do.
with like a translator to make sure we're actually getting what he meant.
Exactly. And you know what's really wild? Graham started on Wall Street back in 1914.
1914.
1914?
He had no idea what was coming.
No clue.
World War, market crashes.
The Great Depression, he saw it all.
It's kind of mind-boggling when you think about it. But here's the thing that really struck me. Through all that chaos, Graham realized the core principles of sound investing. They still held true.
Isn't that encouraging?
It is. Makes you feel like maybe, just maybe, there's some order to all this madness.
There is. It means no matter what crazy stuff is happening out there, the fundamentals still matter. They always will.
So let's get to the heart of it. What exactly does Graham mean by this whole intelligent investing thing anyway?
This is where it gets really interesting. See, for Graham, being an intelligent investor, it has very little to do with, your IQ.
So I don't need to be some kind of financial genius.
No, not at all. It's more about your temperament, your character, even.
Oh, so like being able to keep a cool head when everyone else is losing theirs?
Exactly. Patience, discipline, and emotional control. Graham actually says it right in the book. The kind of intelligence we're talking about is a trait more of the character than of the brain.
Yeah, I think we could all use a little more of that these days.
Totally. And Graham, he learned this lesson early on. There's this great story in the book about his experience with a company called Savold Tire. This was back in 1919.
Oh yeah, this one's a wild ride.
So, first day of trading, Savold Tire stock goes through the roof.
Like how much are we talking?
Graham, he sees like a 250% return. Just like that. Easy money, right?
Seems like it.
But then, just a few months later, the whole thing completely unravels.
What happened?
Turns out, Savold Tire was a complete fraud.
Oh no.
And the stock, worthless, poof, gone.
Ouch.
It was a brutal lesson. And it really drove home that point. Getting caught up in the hype without understanding the business, it can be disastrous.
Absolutely.
Which brings us to Graham's views on market forecasts.
He wasn't a big fan, was he?
No, not at all. He thought trying to predict those short-term market movements was basically a fool's errand. He's like, even the so-called experts get it wrong all the time. Like even Alan Greenspan, former Fed chairman, even he made some disastrous predictions.
Okay, so no relying on forecasts. Got it. But what about jumping on those hot new IPOs? Everyone's always chasing the next big thing.
Another area where Graham, he urged a lot of caution. He saw this play out way back in 1825.
1825.
Yeah, with the Bank of Southwark IPO. People were literally trampling each other to get their hands on those shares.
Sounds a little familiar, doesn't it?
It does. Right. Kind of reminds you of the frenzy around some of those tech IPOs today.
Definitely some parallels there.
Yeah.
So what happened with the Bank of Southwark? Did those people get rich?
Well, not exactly. Within a few years, those shares, they actually lost about 25% of their value. Graham's point was that chasing hot IPOs is often driven by speculation and hype, not sound investment principles.
So if we can't trust forecasts or chase IPOs, how are we supposed to approach investing? What's the alternative?
That's where Graham's two core approaches come in.
Oh, here we go.
The defensive investor and the enterprising investor.
All right, lay it on me. Defensive investor versus enterprising. Which one am I?
Well, it depends. The defensive investor, that's like the set it and forget it approach.
Yes.
Steady returns, minimal effort, all that good stuff.
It does sound kind of nice. Line me up.
For that, Graham suggests you go with a core portfolio of 50% stocks and 50% bonds. Simple, right?
Sounds simple enough, yeah. But wouldn't that kind of limit my potential returns? Like, wouldn't I be leaving money on the table? Some people might say I need to be more aggressive if I really want to grow my wealth.
That's a common thought. A lot of people think that. But remember, Graham lived through some crazy market swings. He saw how speculation, chasing those high returns, well, it can really backfire. The defensive approach is about minimizing risk and building that wealth steadily over time.
So peace of mind, basically.
Exactly. It's about knowing your investments are diversified, you know they're aligned with your goals, you can sleep at night.
I can get behind that. So for that stock portion, would Graham say to just pick individual stocks? Because that seems like a lot of research, a lot of time.
Yeah.
Not exactly hands-off.
You're right. That's why Graham was a big fan of index funds. especially for the defensive investor.
Ah, index funds. You're basically buying a little slice of all the companies in an index, right? Like the
Yeah.
S&P 500.
Yep, you got it. Instant diversification, no need to spend hours researching every single stock.
And I've heard people talk about dollar cost averaging. Is that something that goes along with index funds?
Definitely. It's a really powerful strategy, and it's super simple. Instead of trying to time the market, buy low, sell high, you invest a fixed amount at regular intervals, regardless of what the market is doing.
So like if the market's down, I'm buying more shares at a lower price. If it's up, fewer shares at a higher price. It kind of balances out, right?
Exactly. It all averages out in the long run. Plus, it takes the emotion out of investing. No more panic selling when the market takes a dip.
That is tempting, I gotta admit.
It happens to the best of us. Dollar cost averaging keeps you disciplined, sticking to your plan no matter what's happening out there.
Staying calm amidst the storm. I like it.
Now let's talk about the bond part of the portfolio.
All right, bonds. I know they're supposed to be safer than stocks, but I gotta be honest, I find them kind of confusing. There's so many different types.
I hear ya. Bonds can definitely be a bit intimidating, but they're super important for a balanced portfolio, especially for the defensive investor. One thing to consider is taxable versus tax-free bonds.
So taxable bonds, I pay taxes on the interest I earn. Tax-free bonds, no taxes, right?
You got it. But which type makes more sense for you, it depends on your tax bracket. Let's say you're in the 35% tax bracket and you're thinking about a bond yielding 5%. After taxes, you're really only getting like 3.25%. But a tax-free bond yielding 3%, well, you keep all of that.
So higher tax bracket, probably better off with tax-free bonds.
Makes sense, yeah. It's worth crunching the numbers to see what works best for you. Then there's the whole question of bond maturity. Do you go short-term or long-term?
Ooh, maturity. I think I'm missing something here. What's the difference?
Short-term bonds, they mature faster, usually less than 5 years. They're more stable, less likely to fluctuate like crazy. Long-term bonds, those mature in 10 years or more. Potential for higher returns, but they can also be more volatile when interest rates change.
So if I'm all about avoiding risk, shorter maturities are probably the way to go.
It's a solid strategy for sure, especially for that defensive investor mindset. Now, let's flip the script and talk about that enterprising investor, the one who's ready to roll up their sleeves and dig a little deeper.
All right, bring on the bargain hunting. This is where it gets really interesting. I want to find those hidden gems in the market.
Exactly. The enterprising investor is on the hunt for those undervalued opportunities. Companies trading for less than their true worth. Graham breaks these down into a few different types.
Like what? Give me the goods.
One type, you're looking at companies with what's called net working capital. It means their net current assets, that's stuff like cash and inventory, minus their current liabilities, it's greater than their market cap.
Okay, hold up. Back up a sec. Can you explain that in English?
Sure. Imagine a company, they've got $10 million in current assets and $5 million in current liabilities. That means their working capital is $5 million. Now, if their market cap, the total value of all their shares, is less than that $5 million, boom, you've got a net working capital situation.
So you're basically buying the company for less than the value of their stuff.
Pretty much, yeah. In theory, even if they went belly up tomorrow, you could sell off those assets and get your money back. It's all about buying with a margin of safety.
I like the sound of that.
Yeah.
What other bargain hunting strategies did Graham have up his sleeve?
Another approach is to look for companies with hidden earnings potential. They might be undervalued right now, but it's temporary. Maybe it's because of market conditions, some bad press, who knows. But their true earning power is much higher.
Sounds like finding a diamond in the rough.
Exactly. Graham talks about Northern Pacific Railway in the book. He dug into some reports and found out they had bonds that were worth more than their stock price.
No way. How did he even find that out?
It shows how important research is. You got to go deeper than just the stock price. Understand the company's financials, their operations, their management, everything.
So it's like becoming a financial detective.
I like that. You're searching for clues, piecing together the puzzle to uncover those hidden gems.
Now that sounds fun.
And speaking of uncovering hidden value, we got to talk about one of Graham's most important concepts, the margin of safety.
All right, this sounds like a big one. I have heard the term, but I'm not sure I totally get it. What does it mean, practically speaking?
In simple terms, it's the difference between what you pay for an asset and its intrinsic value. Think of it like a buffer, a safety net. It protects you from losses, even if you made a mistake in your calculations.
So you're saying buy it for a lot less than it's actually worth.
Exactly. Graham compares it to building a bridge. You don't just build it to hold the expected weight, you build it to handle way more, just in case.
Makes sense, like those old, super sturdy bridges that have been around forever.
Mm.
But how do you figure out a company's intrinsic value? Isn't that kind of subjective?
It's true. It's not always an exact science. You got to look at their financial statements, their earnings potential, their assets, so many factors. There's different ways to value a company. Maybe we'll do a whole deep dive on that sometime.
Sounds like a plan. But for now, why is this margin of safety idea so important? Especially in today's market, which can be pretty unpredictable.
Because the market isn't always rational. Prices can go up and down like crazy based on emotions, news headlines, all sorts of things you can't predict.
Yeah, we've seen some wild swings lately.
Having that margin of safety built in gives you a cushion. You can ride out those waves and come out stronger. What's interesting is, back in 1972, when Graham updated the book, he actually saw a negative margin of safety in the market. He thought a lot of stocks were overpriced.
Really? Even back then?
Yeah. So how do we find those opportunities where the margin of safety is working for us, not against us? Well, it takes patience, discipline. You got to be willing to go against the crowd. You're not looking for the hottest stock. You're looking for solid businesses that people are overlooking.
Businesses that are maybe a little out of favor.
Exactly. Misunderstood, ignored. It's about controlling your emotions, not getting swept up in all the hype.
It's more about psychology than anything else.
You got it. Human emotions, especially fear and greed, they can really mess things up.
Yeah.
Think about that classic saying, buy low, sell high. Sounds so simple, but how many people actually do it?
Not many, I'd guess.
It goes against our instincts, you know? When the market's tanking, it feels scary to buy. When it's soaring, everyone wants in, even if prices are inflated.
We're basically programmed to do the opposite of what we should be doing.
Mhm.
So how do we break free from that? How do we start investing intelligently?
That's where Graham's wisdom is so powerful. He gives us this framework for thinking about investing, and it goes beyond market cycles and emotional roller coasters.
And to illustrate this, we have to talk about one of Graham's most famous students, Warren Buffett.
Ah, yes. Specifically his essay, The Super Investors of Graham and Doddsville.
That's a classic.
It is. In that essay, Buffett analyzes 9 investors who consistently beat the market. And they all used Graham's principles.
Okay, so we've got these super investors, all following Graham's teachings and crushing the market. What's their secret? Was it just dumb luck?
Nah, luck wasn't really the main ingredient here. It's interesting, these investors, they had really different styles. You know, some were all about focusing on just a handful of stocks. Others had way more diversified portfolios. But what they all had in common, that rock-solid commitment to Graham's principles.
So it's not like there's one magic formula or like a set of rules you just follow blindly.
It's more about the mindset, I think,
Yeah.
a way of thinking about investing, putting value first, not speculation. Buffett actually talks about this in his essay. He says these super investors, they all had this shared philosophy, like they were buying businesses, not just pieces of paper.
That makes sense when you put it like that. But it also kind of sounds intimidating, you know?
Hmm.
I'm no Warren Buffett. I don't have millions just lying around to invest. Does this approach actually work for, like, the average person?
That's the cool thing. Graham's principles, they're totally scalable. Whether you're managing billions or just starting out with a few thousand in your retirement account, it applies. It's about really understanding the business, figuring out its true worth, and then buying it at a price that gives you that margin of safety.
Anyone can do that, right? With a little research and some patience.
Right. And Buffett's essay, it's a pretty strong argument that this approach works. I mean, these super investors, they weren't just barely beating the market. We're talking consistently outperforming year after year.
So, like, even when the market was doing poorly, they were still coming out on top.
You got it. That's the power of that margin of safety. When you buy something for way less than it's worth, you can handle those market ups and downs. Remember that Washington Post example we talked about earlier?
The one where the market valued it at like 80 million, but they could have sold their assets for way more,
Yeah.
like 400 million?
Yep. That's a perfect example of how stock prices can get totally disconnected from what a business is really worth. And if you get Graham's principles, you can actually take advantage of those weird situations.
It's almost like finding, I don't know, a $20 bill just lying on the street.
Right. But the thing is, you got to be patient. Sometimes it takes a while for those opportunities to pop up.
No get-rich-quick schemes here, huh?
Nope. This is about playing the long game, building wealth slowly and steadily, making those smart investment choices, tuning out all the noise, and just focusing on the fundamentals.
So as we wrap up our deep dive into the intelligent investor, what are the big takeaways? What do you want our listeners to remember?
I think the most important thing is becoming a more intelligent investor. It's not about some secret talent or knowing the right people. It's about developing that right mindset, being patient, being disciplined, and really focusing on value.
Not treating investing like it's gambling.
Exactly. It's about owning part of a business and being in it for the long haul.
It's thinking like an owner, not just someone trying to make a quick buck.
Right. And if you can do that, well, you're on the right track.
This conversation has really changed how I think about investing. It's a lot to process, but in a good way.
I'm glad to hear that. And speaking of thinking differently, I've got a question for you and for everyone listening.
Hit me with it.
How could you apply that idea of margin of safety, not just to your investments, but to other parts of your life too? Your career, your relationships, even just everyday decisions.
Ooh, that's a good one. Makes you think about risk and reward in a whole new way.
Something to ponder.
Well, that's all the time we have for today's deep dive. Thanks for joining us. We highly recommend checking out The Intelligent Investor yourself. It really can change how you approach money and investing.
Absolutely. And remember, becoming a more intelligent investor, it starts with this one step. Take what you've learned and start putting it into action.
Until next time, keep learning, keep exploring, and happy investing.